All right, so let's begin the show and let's talk about having a 5-year-old portfolio or a strategy that you should be adopting for the next 5 years in your portfolio in terms of rebalancing, reallocation, what you should be looking at, what are the bets. Let's invite Feroze Azeez, Deputy CEO, Anand Rathi Wealth. Feroz, good evening and welcome to the show. So in Hindi, I'm calling it Panch Varshya Nivesh Yojana. Okay, so you are going to help our viewers with a 5-year investment plan. Be it someone who will be forming a portfolio now or someone who already has an existing investment portfolio. Key reasons before you give us the right bets or strategies, I want you to help our viewers understand why is it the right time to maybe reshuffle or rebalance your portfolio. Not that you shouldn't be doing this. This has to be a very normal procedure as far as having an investment portfolio is concerned. But then now, why is it the time to go in for it, Feroz?
Like you rightly pointed out, Kavita, rejigging the portfolio or monitoring your portfolio is an annual exercise which you always should do. But there are some periods which are more momentous from a perspective of their timing, that at that point in time, reviewing your portfolio, making changes makes perfect sense. Now, if you come to the contemporary situation that the election is over, general election is over, the mandate of the new government is also reasonably clear. The NDA is going to form a government in 99% of the situations, which is going to be a stable government because you have 292 seats on a pre-poll alliance. In UPA 1, UPA 2 also, you would not see one single party having a majority greater than 272, 273. So it's a stable government. That's one thing behind us now. Second, most important is markets have gone through a lot of change. Not just on the headline Nifty number. If you look at last year, Nifty's performance from 17,000 odd to 23,000 today, that's a reasonable move. And if that's the Nifty number, you see mid caps having run up last financial year 60%, small caps approximately have run up 60%. So this is a dramatic change, and in terms of price and the broader market rally. So whenever you see a large event is over, huge change in price. That's a great start point to say this is a point at which a huge review is required. When you review, what all do you review? You review asset allocation of your full portfolio. You review product class selection. You review scheme selection. All these three items deserve a full-fledged zero-based review for sure, Kavita ji.
Sure, sure. Along with this, Feroz, one more mantra of making money in the market is, earning growth, dividend yield, and PE. But then talking about the portfolio strategies, how should one begin with? Assuming someone already has a diversified portfolio, we've been seeing a lot of investor interest going through a sectoral and thematic allocation. A lot of investors looking at fund managers strategies, because this is the time when even fund managers would want to rejig their portfolios. Obviously a lot depends on the kind of the cabinet formation and who gets the ministry and the kind of policy and reform announcements that we all are waiting. Budget is a very main event for us to get an idea of where exactly the government is going to move in terms of their policies. So far, it said that economy facing policies are not likely to be changing. But having said that, what's the first step towards changing your portfolio and making it a 5-year-old profitable portfolio one should be taking?
Kavita, like you said, the one more short way of making money in the markets, and you said whatever you said. I think one more method I know is listen to Kavita's show, and that's one of the short ways
Thank
to
you.
create awareness, because a fundamental education is mandatory. People watch so much entertainment, but they get bored in 2 minutes of watching something which can actually change their financial status. So I would say the short of making money and creating a foundation for investing is look at all the shows you've been putting together with the great experts, other than me, of course. I would not call myself one. That's one suggestion I have to all viewers. Spend time
That's
in.
really kind of you, and thank you so much for being a part of this financial literacy journey along with us, Feroz. It's been a very long association, and I just hope our viewers get to learn a lot from you.
and it was heartfelt. Coming to the more important question which you really posed, and it was an important question, is I think sectoral funds is one thing you touched upon. I have been a firm believer that an investor should not touch a sectorial or a thematic fund. Why? Because thematic is okay. Sectorials are very specific. Financial services, pharma, IT, all those are very, very narrow mandates given to a fund manager. Generally, when an investor buys any of these sectors or themes, the theme is already very popular. Like just 15 days back, everybody was saying buy defense, infrastructure, railway, highway, and everything. And the diversified fund manager, if you have bought a diversified fund, the fund manager has already skewed his portfolio to defense, highway, railways, infrastructure. And then on top of it, you also buy 25% of a thematic fund, then you're doing the same thing. Then suddenly you have so much exposure to specific sectors because the normal fund manager is also skewing there and you're buying specifically, separately, an extra allocation. This is the mistake which most people did in 2008. So that's the learning from the older generation to the Gen Z. That's point one. Point two, there are different fund managers following different styles. The more popular nomenclature in style is growth and value. Okay, growth is buy something which is doing well, which is growing, the company is growing faster, may not be available at the cheapest price. That's the definition of growth style. Buy anything which is growing as a business, price your price inelastic. That's growth. Value, if I have to describe for the benefit of the viewer, value is buying some company which is cheap, might not be growing astronomically, but it's available to you at a cheap price today. When everybody realizes it is cheap, you will make money and everybody will come to buy that share. These are the two styles. There are two AMCs which distinctly follow this style across several schemes, which is Nippon and HDFC, are generally more value based. They buy cheaper stocks if you go PE as the barometer. So I would say a blend is what will work well in the next 5 years rather than one of those. Value did well for the last 3 years. But I think next 5 years, it's going to be more muted, both the sides. I think a blend is what is more critical for the next 5 years.
Sure. So that is going to be in terms of strategies. But then what about asset allocation? You think one can go high in terms of equity exposure, or that really needs to be capped and a certain amount of exposure is really required in debt, considering a rate cut scenario coming up soon, later this calendar year?
Kavita, if you ask me for 5 years, money, if your money is for 5 years, condition one. Condition two, for a fall of 10-12% doesn't bother you too much. In the interim, if these two conditions are satisfied, you should have at least 80% of your long-term money in equity. Mark my words, 5 years from now, which is 2029, it is very low likelihood that equity funds would have underperformed debt funds. Okay, there's a 90, 95, 99% probability that the equity funds would outperform debt funds. If your passing mark is 8%, 7%, it is very unlikely that a good equity fund will not pass over a 5-year holding. As long as you can hold your nerves when there are market falls of 10, 12%, which is very, very possible several times. In the next 5 years, at least 4 times market will fall 10%. If you're able to mentally prepare, I would say 80% is the minimum equity allocation for 5-year plus monies for anybody who is less than 55 years of age.
Sure. Feroz, for all those investors, who are stock pickers or maybe have good amount of exposure and understanding towards equity via mutual funds also, what could be another strategy where, if they just kind of analyze their risk, they know if at all they can go slightly more heavier in equity, can explore various other categories as well. Is there anything like that you would like to recommend to those kind of investors who have their risk profiling done already?
If they want more risk to generate more return, I would say first asset allocation is the first tool of increasing risk and increasing return. If you actually want to increase return further, I personally think of a fund, which I can name the fund as well to be more specific. SBI Infrastructure Fund is one fund which has the potential to give 2-3% more then a diversified equity fund counterpart on the flexi cap or the multi cap category. The reason is because it's a smaller fund of SBI, relatively smaller fund. Second, it is not so infrastructure driven. It is little more broader than a conventional infrastructure fund. Has the SBI as a fund house has a lot of understanding of how governments operate because it is a government run company at the end of the day. So their understanding of government expenditure is a lot more. Their analysts are well tuned to understand infrastructure as a theme. So I would say if you want that little extra kicker to your portfolio and you're going to be patient for 5 years in this full term of this government, I would say an SBI infrastructure is a good addition to your portfolio, all else equal.
Any contra bet that you would want to recommend, Feroz?
See, I think, of course, SBI Contra is one of the funds which have been in our portfolio. But when we recommended it to a small fund, it has played out immensely. It's still a part of our model portfolio. I think today, most funds which are not value have become contrarian bets. If you look at the most conventional financial services, is available at dirt cheap prices. It is the largest weight in the index. If I'm not wrong, in Nifty, it's about 30 odd percent, 30 plus percent. It is the cheapest index to my mind for the growth it gives or growth it is expected to give over the next 3 years, 4 years. So I think the conventional has become the contra because value used to be the contrarian approach. Value has done so beautifully over the last 3 years. Like last year, NSE 500 value 50 has done 61%. Okay, last 3 years it has outperformed the conventional market. So the contrarian bet is the conventional today.
Sure. Feroz, now coming back to the mid cap and small cap space, okay, the fall that we saw earlier this week, can we say the froth that you were talking about that's building up in these particular market caps have gone now? The valuations are pretty reasonable, or maybe in some pockets you might get good valuations. And keeping that in mind, there was a narrative earlier where we all were thinking that the large cap would make a new story or a better story, and then we would see the froth clearing up from mid cap and small cap. That did not happen. In fact, there was a lot of investment, a lot of investors' interest regularly coming in mid cap and small caps. Do you think the narrative over there has changed now, the way people look at mid-cap and small-cap? Obviously, they need to do their risk profiling, but then their appetite to take that particular risk has gone up. There has been a better understanding, and so one can also look further and explore more, especially in the small-cap space where you have some appetite for micro caps also.
Kavita, yes, there's so many things you touched upon, and I want to make some clarification, which I also learned in the last 5, 7 years. When I heard the word small cap always, what would come to my mind as an investor or as a distributor used to be risk. Then when I numerically measured risk of the small cap index and compared it with Nifty, the risk numerically on an Excel sheet, if you calculate the risk was not very different. So we did this hypothesis testing. Why is small cap not showing so much more risk as much as the perception of you and me? We realized there were two reasons, or largely one reason. See, when we speak small cap, NSE small cap 250 has 250 stocks. And Nifty 50 has 50 stocks. It is not 50 compared with 50. If there were 50 small cap stocks compared with 50 large cap stocks, I'm sure the small cap will throw up a larger risk. Small cap is far more diversified in terms of number of stocks than a large cap category. That's one reason why risk was lower. The second very important reason, which you will not read in books or disclaimers, is that Nifty has very large proportions invested in the top stocks. If you look at the top 10 stocks of Nifty, that is 65%. The top 10 stocks of small cap is not even 18%, 16%. So large cap have very large weightage to some stocks. Now, if I spoke of Anand Rathi Wealth Limited, we are a listed company. We are in the top 1/3, but our weightage is 0.4%. Such a small weightage in NSE small cap 250. So point I'm saying is don't be so intimidated with small cap, because small cap, you will have a Nippon small cap with 200 stocks in it. You will never find a large cap stock with 200. The universe itself is 100. So that's point one. So please have at least 25% this year also in small cap. because small cap, there are some stocks which are very expensive. There are some stocks which are very cheap also. So small cap exposure for us this time is 25%, mid cap exposure is still 20%, and 55 goes to large cap. This is our new model portfolios proportions, which I was justifying a bit.
All right, so 5 bets for 5 years investment portfolio. Thank you so much, Feroz, for being a part of this very important discussion and helping our viewers with their investment portfolios today. Thank you.
If you like this video, then like, share and subscribe to ET Now.